There's a lot riding on Nvidia's results later, with investors already questioning company's massive spending on AI. Nvidia reports after the bell on Wednesday it's considered the #1 indicator of whether AI is actually delivering shareholder returns after China's DeepSeek panicked the markets in January with a seemingly much cheaper model. The market estimates its fourth quarter sales at about $38.5 billion, and options point to a move of about 8% in either direction if the results surprise. Chris Rossbach is Chief Investment Officer at J. Chris, these results are about much more than just Nvidia itself, aren't they? What will they tell us about the broader AI landscape?
Yes, I think they are very important because we've seen that there's a lot of uncertainty around AI, and we can see after the exceptionally strong performance of the company and the massive growth that it's been able to achieve that there's a degree of nervousness. That's what we saw, I think, with the DeepSeek moment in January, but I think what we've also seen is a lot of indication that the use cases are significant, that the need for CapEx is massive, and therefore I think that there's reason to believe that the results will be fine, and frankly, I think regardless of how they turn out, whether they're in line better or worse, it doesn't change anything about the fundamental case for AI.
As you mentioned, Chris, that massive capex in AI has continued, and after the DeepSeek shock, investors did buy the dip. But should they be asking bigger questions about whether this scale of investment will pay off, or how soon?
I think the DeepSeek moment has shown just how much computing power is necessary, but also that there are many different types of applications that can run on the large language models that provide the underlying compute. So if you look at what the hyperscalers have announced in terms of capex for this year, 360 billion. If you look at what the European Commission has announced, 200 billion. France has announced another 100 billion. That's just those companies and those entities that are investing. I think it shows that the people actually involved in putting together the capacity have a need and see the opportunity. And what investors need to do, I think, is look at the fundamentals. We're just at the very beginning in terms of understanding where those use cases are. And moments like DeepSeek show just how much opportunity there is.
This morning, Chris, China accused Taiwan, whose TSMC is, of course, the world's largest chip maker and a major supplier to Nvidia, of trying to give away its chip industry to the US. How much should investors be worrying about chip making being tangled up in geopolitics?
Well, it's absolutely critical because the future of computing is going to go through these processors, and TSMC is in a unique position because of its capacity to produce them. They've started to diversify their fabs with the investments that they've made in the US, in Japan, in Germany, in Dresden, where they've built a fab. But clearly the focus of it is in Taiwan. There are going to be geopolitics around these issues, but I think that the important thing is just how critical it is for the global economy as a whole. And so I think as we are seeing a period of increased trade tensions between China and the US and between other big trading partners, we also have to see that there continues to be a level of pragmatism. If you see, for example, the significant sanctions that were threatened by the U.S. against Canada and Mexico, they've been effectively taken off the table for now because concessions have been made. And so I think there's a lot of deal-making that's involved, but I think that the underlying need for this capacity and the fact that TSMC is critical to it, I think is imposing a degree of reality on these tensions. And again, I think what investors need to do is to focus on the underlying fundamentals of the demand for this compute and of the supply and where it's coming from. And I think those should give comfort.
More broadly, we have seen jitters across Wall Street in recent days after surprisingly weak consumer data in the US at the end of last week. Are investors right to be nervous?
Again, I think it's a question of where we are. We have come through an extraordinary period. We've come through the pandemic with all the disruptions that took place because of that, and then we came through a period of extraordinary inflation that has led also to extraordinary interest rates that have now all normalized. It's clear that the underlying economy, especially in the US, continues to be robust, It's clear now that interest rates at these normalized levels are probably at the right levels, and the Fed cuts that have been anticipated may take longer to come through because they're not necessary to support the economy, and that inflation is higher. But what's clear also is that employment is strong, incomes are rising, and so I think we're at a moment of greatest concern, where I think the consumer products companies are looking at a turnaround, having absorbed the price increases, having now the resources to reinvest back into their brands. And as we've seen some of the issues that they've had, including their underlying performance and their share price performance, I think it's a moment of opportunity. And again, the focus is on the fundamentals, on the underlying robust consumer economy, and the fact that consumers are now unsettled because of some of the politics that are going on, some of the changes, I think is natural. But the underlying economy and employment continue to be robust.
That was Rossbach of J. Don't forget, you can watch more videos on Reuters.com.